Hi, I'm Hafiz again, and I'm going to take you through to this area of the exam syllabus, which is the fixed and flexed budgets. Let's have a look at how the fixed and flexed budgets work. If you remember from the previous session, which was about budgeting types, we had seen a number of budgeting types, traditional and alternative. And in the traditional approach, there was one budgeting type which was periodic or fixed budgets. Meaning to say is, fixed budgets are set for a period of time, generally 1 year. And another characteristic is, fixed budgets are set for one or single level of activity. Meaning to say, right at the beginning of the year, if we have a periodic or fixed budget, fixed budgets are set for one or single level of activity, meaning sales department will give us the sales plans, how many units they will sell, and those units will never change for the whole year. That will remain a consistent plan for the whole year without any change, update or revision. If the production department gives us their production budget, how many units will be produced over the next year, that production activity remains constant throughout the year. That's the meaning of fixed budget for a single level of activity. Now the idea is, if the fixed budgets are produced for a single level of activity, are we not assuming that there will be no change or fluctuation during the year? So the first problem, as I was defining the fixed budgets, you might have noticed that the problem is that no, things change. As the economy moves up or down, society moves up or down, economic or social factors change, government rules or laws change, things change. So it may not be viable that if we set budget for one level of activity and throughout the year we consider this one level of activity will not change. It may change, okay? Right. Also, another problem in the fixed budgets is that when we receive the actual results at the end of the year, we compare the budgeted results with the actual results and we get a variance. A number of times the managers do not accept or appreciate this variance. Let me give you one example why the fixed budgets do not help us in variance analysis. Okay? Just imagine that at the beginning of the year we had fixed budget to produce 100 units to spend $1,000, meaning we budgeted we will produce 100 units and the cost of 100 units will be $1,000. At the end of the year, we received actual results. Okay, at the end of the period, we received actual results. As per actual results, we produced 150 units. And by producing 150 actual units, we have spent $1,400. Now, the traditional fixed analysis works in this way in a number of organizations, mostly public sector organizations, as well as some private sector organizations as well. When we compare our original budgeted results with the actual results in this way, that budget was to spend $1,000, we actually spent $1,400. And the variance is $400 adverse, meaning there is an overspending of $400 in this period because we planned or budgeted to spend only $1,000 and actual incurrence was $1,400. So a number of people may interpret the results in this way, that we have spent $400 more than the budget, which we shouldn't have. Okay. Now, did you notice a number of people may start smiling on this comparison, that it's not very much justified. Remember, almost in every session I mentioned that in general management accounting, or actually in finance or accountancy, the most acceptable and logical comparisons are when we compare like with like. Okay, comparing apples with pears is not a comparison. Okay, comparison is when we are comparing two similar identical things. So, as per fixed budget, a number of people may say, well, hang on a moment. Original budget of $1,000 was set for 100 units. And if we have made more units, we ought to spend more money. Okay? If we produce more units, we will spend more money. And if we produce less units, chances are we will spend less money. Okay? Then why this $400 is adverse? Meaning to say, should we only produce 100 units? What if the demand is 150 units? Should we still produce 100 units because it's fixed budget? And a number of people said, no, that's not logical. If we get more customers, we should produce more, and we should sell more, and we should generate more revenue. So, producing more and selling more is not a bad thing. But fixed budget analysis is telling it is something bad we have done. On the basis of this problem, what we do is we apply the principle of flexed budget analysis. Okay, we apply the idea of flexed budget analysis, which we are going to look at in a moment. Okay, we are going to look at a moment. Another characteristic of fixed budget is when actual volume of production and sales during the control period are achieved, a fixed budget is not adjusted to the new level of activity, meaning we simply compare original budgeted results with the actual results without any adjustment. Okay, it has some usefulness. That's why a number of companies actually stick to fixed budgets, a number of organizations. Okay, it's likely to be useful in circumstances where the organizational environment is relatively stable, meaning to say what they have planned, they know for some reason, because of the past consistency, past trends, that more or less the same will happen in future. And then if the results can be predicted to some degree of certainty, then fixed budgets can be very much okay. So when there is a consistency that at the start of the year we knew we will produce 500 cars, and at the end of the year we had produced 500 cars, then fixed budgets are very useful. But if we budgeted we will sell 500 units and at the end of the year we had sold only 300 units, then the fixed budget may not work. So when level of activities, actual level of activities remain inconsistent with the budgeted level of activities, then fixed budgets work quite well, periodic budgets work quite well. But if there are any fluctuations in certain industries or certain businesses or organizations, then fixed analysis doesn't work, or it doesn't help that much. In order to address this issue, we look into the flexed budgets, okay, or flexible budgets. Flexible budgets are budgets set at different level of activities, that what if we produce more than original planned results, or what if we produce less than original or planned results, just to see what happens if we produce more or sell more. Idea of the flexed budgets, okay, flexible, here I mean to say is flexed budgets. Idea of the flexed budgets is not to plan. Flexed budgets are not used for planning purposes. Flexed budgets are used for control and performance evaluation purposes. Flexed budgets are not produced at the beginning of the year. Flexed budgets are produced at the end of the year. Let me repeat. Normally we produce budgets at the beginning of the year, right? When the new year is almost going to start, then we have the budgets. But flexed budgets are not produced at the beginning of the year because they are not used for planning purposes. Flexed budgets are used for control or performance evaluation purposes. With the help of flexed budgets, we ascertain useful differences or variances. And what we believe is variances are more fair, variances are more realistic, and variances are more acceptable to managers if we apply flexed budgets rather than fixed budgets. Okay? Now, idea of the flexed budget is this. Before you look at the steps, let me show you how flexed budgets will work. If I go back to the previous example, okay? So as per original budget, plan was to produce 100 units and to spend $1,000. Now, can we say 100 units budget and $1,000 budget? As per budget, can we say plan was to spend $10 per unit? 100 units times by $10 equals to $1,000, meaning all I done was $1,000 divided by 100 units. Okay, if I spread $1,000 over 100 units, I get budgeted cost per unit, which is $10. Okay, and what if we produced 150 units? Can I say if the cost is $10 per unit for 150 units, it would or it should have cost us 1,500? Okay, so if budget for 100 units is $1,000, budget for 150 units should be $1,500. Okay, let me repeat. If the budget for 100 units is set at $1,000, the budget for 150 units should be set at $1,500. So, isn't it now comparison of like with like? That we are comparing for 150 units, budgeted cost will be $1,500 and actual cost was $1,400 for the same 150 units. And now this variance becomes more meaningful to the managers or acceptable to the managers, that we are comparing that budget to produce 150 units was $1,500 and actual spending for 150 units was $1,400. So there is actually a saving of $100, not overspending. We spent $100 less than the original budget. Okay, this $1,500 is called as flexed budget. So flexed budget is actually, I can define it here before we look at these steps, specific steps. Flexed budget is a revised budget prepared at the end of the year taking into account actual level of activity, meaning to say actual level of units, actual machine hours, actual labor hours. So flexed budget is a revised original budget or a revised fixed budget, if you fancy. It's a revised fixed budget prepared at the end of the year, taking into account actual level of activity. And the aim of flexed budget is to compare flexed budget with the actual results to get any difference, which becomes meaningful variance, acceptable variance, realistic variance, a like with like variance. Okay, let's have a look at some steps in flexed budgets. A fixed budget is set at the beginning of the year. okay, based upon estimated production. This is the original budget. This is then flexed. This original budget is then flexed to correspond with actual level of activity. Okay. Variable costs and sales revenues are adjusted to reflect actual level of activity. Reason being, variable costs and sales revenue are fluctuating elements. Meaning to say, more volume, more costs and revenue, less volume, less costs and revenue. Okay. So variable costs and sales revenue is flexed in light of the actual activity. Okay. And that the result is compared with the actual cost or actual revenue, and the difference is called as a variance. And then the management can take proper control action. If somebody has done a good job as compared to the budget, we can appreciate them, reward them, and then we can request them to move forward in the same way or even better. And if somebody has not done a very good job, we can sit down together and see how things can be improved, how the last errors or mistakes or poor planning cannot be repeated again. Okay. A number of times the costs are given in a very clear way, that this is variable cost, this is fixed cost. Okay. Now please remember that fixed cost will not be flexed. Okay. Why do we need to know about the variable and fixed cost? Because what we believe is fixed cost remains constant regardless of the volume of activity generally. Okay. So up to a range, fixed cost remains constant. So if we produce 100 units or we produce 90 units or we produce 150 units, fixed cost commitments remain the same. So idea is we only flex variable cost, we do not flex fixed cost. But in an exam question, if for example you are given a semi-variable cost, because you have studied paper F2, so of course this was part of paper F2 that I will revise again. If we are given semi-variable cost, which includes like different type of bills, mobile phone bills, telephone bills, electricity, heating, lighting, etc., where one part of the bill is fixed line rental and the second part of the bill is variable based upon variable consumption. Okay. So if we are given a semi-variable cost, then we can apply high-low method, which helps us to separate semi-variable cost into variable and fixed. Okay. We are going to look into this later on. Now here is the example, but few points actually I like to take into your notice. Okay. Number one, remember we only flex variable costs and revenue. Variable costs and revenues are flexed only because they depend upon level of activity. Fixed costs are not flexed. Meaning to say, whatever the fixed cost is in the fixed budget, we simply copy and paste the same fixed cost in the flexed budget. Okay, we do not change it. Okay, whenever there is a semi-variable cost, we apply high-low method. Okay, and high-low method splits the semi-variable cost into variable and fixed. And now variable is flexed and fixed is not flexed. Okay. So this is the basic understanding of the flexed budget. So here is an example, Strauss Limited. Let's have a look at the information and the requirements, and then we are going to solve it. You have been provided with the following operating statement, which represents an attempt to compare the actual performance for the quarter that has just ended with the budget. So their aim is to compare actual performance with the budget. They've given us 3 columns. One is budget, second is actual, and the difference between budget and actual, budget minus actual equals to a variance. Somewhere you can see in this variance column numbers are positive, somewhere you can see numbers are negative, plus and minus within the brackets are negative. Okay, positive simply reflect favorable results and negative simply represent adverse or unfavorable results. So let's have a look at this statement first. Number of units sold. Okay, we are provided that budget was to produce and sell 640 units, or there are 3 zeros as well, so 640,000, whereas actually they produced 720 or 720,000 units. So they produced 80,000 units more. Now, do you think if they would produce 80,000 more units, they would spend more money? And if they would sell 80,000 more units, they will generate more revenue as well. So, comparing the cost of 640 units with 720 units is not a comparison of like with like. It is like comparing two completely different things. And managers will say, how come you are comparing the cost of 640 units with 720 units? 640 units will cost us differently and 720 units will cost us differently. Of course, right comparison is in one of the two ways. Either we should compare budgeted cost of 640 units with actual cost of 640 units. Or the one we are going to do now would be the flexed budget idea, in which we will compare the budgeted cost of 720 units with actual cost of 720 units to see how much we should have spent for 720 units and how much we did spend for 720 units, and the difference would become more meaningful and acceptable to the managers. Okay? So the original operating statement may not be very meaningful. They given us cost of sales and they told us they are all variable. Why variable? Because we flex variable only. Then we are given fixed labor cost, and please remember we do not flex fixed costs. Selling and distribution variable and fixed, administration variable and fixed. We only flex variable, do not flex the fixed. Then we are provided sales, and of course sales revenues depend on the number of units, so sales will be flexed. Requirement A. Using a flexible budgeting approach, redraft the operating statement so as to provide a more realistic indication of the variances and comment briefly on the possible reasons other than inflation why they have occurred. Okay, this is requirement A. Let's have a look at the requirement A first, then we will look at B and C separately. Okay, they asked us to prepare the new statement based upon flexed budgeting idea. So what I will do would be, okay, just to save little time and give you better view, I would insert one column in between budget and actual, and that will be called as flexed. Flexed budget. Okay, right? That's called as flexed budget. Right, let's start developing flexed budget. First of all, let's have a look at the cost of sales. First is materials. As per original budget, material cost is $168,000, and as per budget, number of units are 640. So what we do is exactly the same idea as I had applied in my Mickey Mouse example before. Remember what I did was here, that as per budget, $1,000 divided by 100 units, that gave me $10 per unit. And $10 per unit multiplied by actual activity equals to the flexed budget. Exactly the same principle I'm going to adopt here as well. That as per budget, material cost is 168, I'm ignoring 3 zeros, divided by 640 units, that gives me material cost per unit as per budget. Okay, and then I would multiply that material cost per unit by the actual activity 720 units and I will simply get flexed budgeted cost of materials. So here is my little calculator, 168 over 640 times by 720, which gives me 189. $189, and this becomes the flexed budget. Okay, so let's do the flexing and then we will work out the variances. Labor, exactly the same principle, 240 as per budget, which is that, divided by 640, which is budgeted volume, multiplied by the actual volume, which is 720. And here is the flexed cost, 240 divided by 640 times 720, which is 270. 270. Now this is the flexed budget for labor cost. Okay. Now the next one I'm looking at is overheads, which is exactly the same principle because these are variable, so I need to apply the same flexing step. 32,000 divided by 640,000 times by 720,000, which comes to 36. Okay, let's have a look at the next one, fixed labor cost. Remember, fixed costs are not flexed, so this 100 will be copied and pasted as it is. We will not change anything because we know whether we produce more or less, generally fixed costs remain the same. Selling and distribution, first is the fixed, and fixed will be copied and pasted in the flexed budget. Okay. Variable will be flexed exactly on the same lines. 144 divided by 640 times by 720, and that gives us the variable selling and distribution flexed cost. $162. Then administration costs, fixed do not get flexed, 184, and variable will be flexed. So 48 as per budget divided by 640 as per budget, so that gives us variable administration cost per unit as per budget, multiplied by 720 actual units. This gives us flexed or revised budgeted cost for 720 units. Okay, so 48 over 640 times by 720, which is 54. And last one is sales. So we know we flex the sales exactly on the same lines, 1024 as per budget divided by 640 units as per budget and multiplied by 720 units as per actual results, and we will get the flexed revenue or flexed sales. Which is 1152. Okay. So this is all the flexing idea. So you might have noticed a very straightforward topic. So generally comes once in 2 years, 3 years time. Okay. So whenever it comes, it's a good topic to gain marks. Now what we are supposed to do is to calculate variances. So some variances we may have to change. For example, please look at more realistic variance is the difference between flexed budget and actual results. Why it is more realistic, I will show you now. Actual results were based upon 720 units, and now flexed budget is also based upon 720 units. Okay, meaning how much money we should have spent to produce 720 units and how much money we did spend to produce 720 units. The difference becomes more realistic, more meaningful. So 189 minus 144, we get 45, and being positive, we can see it is favorable simply because we spent less than the budget. Now previously it was 24, so maybe the purchasing manager or production manager can argue that before, in the original statement, my performance was being underestimated. I have saved a lot more money, but I was underestimated in terms of my policies. And probably somebody may not be upset, somebody may take things at their heart, okay, that I'm not being fairly appreciated by the top management, okay. So this 24 will not be meaningful. Labor, 270 minus 288, the difference is 18, and that is adverse. F for favorable and A is adverse or unfavorable. Now again the same principle, any managers responsible for the labor cost, they were criticized before that they have overspent $48,000. But in reality, overspending was not $48,000, it was only $18,000. Okay, and somebody can say that because we have produced 80,000 more units than the budget, so in a number of cases when our job or activities increase, we end up doing some overtime as well. So it could be a possibility that some of the jobs or some of the units were produced in the late evenings or weekends when we were supposed to pay the workers more than the normal rate. And in a number of companies, overtime policies work. So that could be one of the reasons that we overspend. Not necessarily it could be a fault or mistake of the HR manager or production manager, but because whenever we expand and we produce more than the plan, things happen. In the variable overheads, there is no variance actually. Whenever the answer is 0, we believe it is favorable, meaning as per but we spent as per budget. We never spent more, never spent less, we spent as per budget, so it's fine. But before it was showing adverse. So some manager who was responsible for the overhead cost may be demotivated because of the previous report. So original operating statement was probably unacceptable, demotivational, and it may not help us for better plans in the future. This is how you can develop the variances. So I have completed the requirement A as well as I explained the requirement B, why the original operating statement was of little use. Remember I was saying it may lead to demotivation, it may upset the managers, managers may not like to continue with the organization, managers may change their work or their policies, and changing the policies may not be very good for the company. I mean to say, my point is this, if I believe I am doing justice to my job, I am doing all my best, I am using all my energies and hard work in the best interest of the company, and the management says you are lazy, you are not working that hard, okay, then I may change my policy. A number of people do nothing and look busy sort of things, okay. If I change because of non-appreciation, then changing myself, how would I change? That if my hard work is not being rewarded, it's better not being rewarded by a lazy work. So a number of people, because we are humans, okay, and a number of thoughts surround us, okay. So a number of people may change their tactics, and changing the tactics may not be very good for the company. They may be, but a number of chances they may not be good for the company. Here is requirement C, which would be the application of high-low method. So we will learn high-low method here as well. Okay, further analysis has indicated that variable overheads for cost of sales are in fact only semi-variable. So up above we were given variable overheads before, but now they are saying they are not variable, they are semi-variable. Whilst the budgeted overheads for 640,000 units is indicated to be 32,000 units, sorry, $32,000, it is felt that budget for 760,000 units would be $37,000. Included in this later cost, later means $37,000, is $1,000 incurred when the activity reached 750,000 units due to extra hiring capacity. Now here is the high-low method. In the high-low method, first of all, the step 1 is, okay, this is the requirement C, application of high-low method. Whenever two or more activities are given, we apply high-low method to split semi-variable cost into variable and fixed. Remember, number 1, we pick highest and lowest activities from the data provided. For example, the highest activity here is 760,000 units and the lowest activity is 640,000 units. And we are given the cost of the highest and lowest activities as well, $37,000. And $32,000. Okay, and now examiner is saying in this $37,000 there is a cost of $1,000 which was included because of the increase in level of activity. So when level of activity reaches 750,000 units, then there is an extra $1,000 incurred. And if you remember F2, okay, or if you don't remember F2, please remember now that whenever the fixed cost increases, once the level of activity reaches at a certain stage and fixed cost goes up, that cost is called as stepped or step-up cost. Stepped or step-up cost. Okay, now please remember, always we compare like with like in any topic, in any area of the syllabus. Is it like and like comparison between highest and lowest? I mean to say, do we have step-up cost in the highest? You would say yes, because activity is more than 750,000 units. Is there any step-up cost in the lowest activity? And I think you will say no, because activity is below 750,000 units. So it's not a like with like comparison. In one level of activity there is a step-up factor, in another level of activity there is no step-up factor. So whenever such happens, in order to make a comparison of like with like, we remove this step-up. There are two ways. Either we can subtract 1,000 here from the highest, or some people do it in this way. Let's add 1,000 there so that there is step up in both of them. So either there is no step up in either of them, or there is a step up in both of them. So one of the two approaches you can apply. Okay, not both of them, just one. Either subtract this step up wherever it is included, or add this step up wherever it is not included. One of the two. Okay, this is step number 1. Now step number 2 is we take the difference. Okay, these are all 10-second steps. 10 seconds mean picking up highest and lowest is like 10-15 seconds. Taking the difference is, you can count the seconds, it will simply be 120,000 units difference in units, and 36, now this becomes 36. Okay, so 36 minus 32 is $4,000. So these are all 10 to 15 second, 20-second steps. Okay, it takes time to explain, but it doesn't take time to apply. Number 3, once we found the difference in cost and difference in units, then we can calculate variable cost per unit, which will be the difference in cost $4,000 divided by difference in units 120,000, meaning when 120,000 more units were produced, 4,000 more dollars were incurred, and we can find out at what rate the cost was changing. So 4,000 divided by 120,000, and we get approximately 0.03, okay, or 0.33 if you fancy, per unit. Once we calculate the variable cost, then the next step is find out fixed cost. Now fixed cost is simply difference between total cost and variable cost. Okay, in order to find out fixed cost, we substitute variable cost into either highest data or lowest data. Let me use the lowest data in this example, and while I'm doing the calculation of fixed cost, you can do the same step with highest level, okay? And you would notice my answer and your answer for the fixed cost will be exactly the same because fixed cost doesn't change, okay? So here is total cost at the lowest activity was $32,000 and variable cost is 0.033 multiplied by 640,000 units. Okay, so 0.033 times 640,000, that comes to this, and if I take away from the total cost, I get fixed cost of 10,880. If you have got slightly different, it's not because of the answers are wrong, it's because it depends on how many digits or decimals you have applied in rounding off. If you have rounded off to 2 decimals, 0.03, your answer may be slightly different, okay? But not to worry about this because it is rounding off or decimal discrepancy, it's not conceptual discrepancy. Examiners are more than happy to see this answer, okay? Once we calculated the fixed cost, now we know we split the semi-variable into variable and fixed, okay? Now let's the last part of the requirement see. Produce a revised flexed budget for overheads contained in the cost of sales for an activity level of 720,000 units. So we are working out revised flexed budget, okay? So here is revised flexed budget for 720,000 units. Okay, first of all, flexed variable cost. Remember, variable cost was 0.033 per unit multiplied by 720,000 units. And here we will get revised flexed variable cost for 720,000 units. Now here is flexed fixed cost, and we will do it here, and then we will look into step up cost as well, or stepped cost. Okay, so first of all, variable cost. So 0.033 into 720,000, that comes to 23,760. 23,760. Now I'm looking at flexed fixed cost. Fixed cost as per my answer was 10,880. Okay. Now, do you think fixed cost changes, or do we flex the fixed cost? Yes, we do not flex the fixed cost. I agree with your answer. So 10,880 will just be copied and pasted as it is. 10,880. Now we are looking at the stepped cost. Let me go back to the question and read one more line again for your understanding. Please look at here. Included in this later cost is $1,000 incurred when the activity reached 750,000 units due to extra hiring capacity, right? And we are preparing the flexed budget for 720,000 units, meaning there is no need of stepped cost because the activity hasn't reached 750,000 units in this budget. Okay, once we will be producing budget for 750 or above, then there will be a step up cost of $1,000, but in this case we do not need that. So plus 10,880, our revised flexed cost budget will be 34,640. That comes to our revised flexed cost budget. Okay, so I'm sure you must have enjoyed this session because it was very straightforward area of the syllabus, flexing the budget. Okay, so I hope you would remind yourself with some study text readings, session notes, and then watching my video maybe another time again, so that when we revise things more, we reinforce our learning and how to come back to us. Okay, mail my tutor. So please come back to us with your feedback, any questions, any concerns. Okay, and we will keep in touch. So all the very best. Take care. Goodbye.